Welcome to Wall Street versus Main Street, a different take on the investment show with our host, Dax White. Dax White is the managing partner of the White Law Group, a national securities fraud, securities arbitration, and investor protection law firm with offices in Chicago, Illinois, and Vero Beach, Florida. The White Law Group has represented hundreds of investors in FINRA arbitration claims against their brokerage firms, and throughout this show, Mr. White will shine a light on some of the tricks of the brokerage industry, while also providing valuable information for investors on how to successfully navigate the investor-financial advisor relationship.
Welcome, everyone. You're listening to Wall Street versus Main Street. I'm your host, Dax White. As the lead-in indicated, this is a different take on the investment show. The objective is not to provide investment advice. I'm not a registered investment professional. Rather, I'm a securities attorney who represents investors in claims against their brokerage firm. We do this throughout the country, and the hope is to pass along some of the information that I've picked up from my practice that I wish more investors knew so that they could avoid situations where they needed someone like me. The hope is to pass along some of the information we pick up in our practice to better inform the investment public so that when you're in meetings with your financial advisor, you're better prepared. You know what questions to ask, you know what things to avoid, you know what red flags might be, so that we can hopefully, even the playing field a bit. The brokerage industry is set up, obviously, to make money. That's the objective of any business. But there's a huge disconnect between the client's understanding of their obligation to you versus their understanding. And it's important to understand the difference, be aware of the difference so that when they're making recommendations, you sort of have the bent of understanding why they might be recommending it and that it may not necessarily be in your best interest. There's a great commercial out there right now. I forget who it's for, but it's a financial advisor making a recommendation, and then he hands his client this huge brick of salt and says, of course, you should take all of my recommendations with a grain of salt. The reality is every recommendation they're making, there's typically some underlying reason that all boils down to dollars and cents, compensation, commissions, fees, etc. And it's important for you as the investor to have some understanding of that so that you can ask the right questions and make sure this is really what you want, really appropriate for you based on your objectives. So that's what we're going to do each week is try to tackle various topics that I think would be good for you as the investor to know. This week, we're going to focus in on by far and away the most important document in the investor brokerage firm relationship, which is the new account form. This is the document that you fill out at the very outset of your relationship with the financial advisor. And although you may not realize it at the time, it's got all of the information that a brokerage firm will use, number one, in approving any transaction that goes on in your account. And then number two, if things go bad, they'll use that document to sort of justify their behavior. So that's what makes the new account form so significant. And if you've set up a brokerage account in the last couple of years, you may even remember it. But this is the document that, it's got a lot of the boilerplate legalese, including, very importantly, particularly for what we do, the arbitration provision, because virtually every brokerage firm in America requires you to forego your right to sue them in court and requires you instead to sue them through it used to be called the NASD, now it's called FINRA arbitration. And that's all we do, are FINRA arbitration claims. But there's almost always language buried in the fine print that says, in your new account form, that says you agree to waive your right to sue us in court, and instead you have to sue us through FINRA arbitration. So, that's the type of boilerplate legalese that's in there that discusses, what our obligations are to you, what your obligations are to us, and, here's what would happen if we get involved in litigation. So you've got some of that boilerplate legalese that a lot of people just gloss over and don't read, but of course has enormous significance if you get into involved in litigation. But more importantly, in terms of both litigation and just the investing component of the relationship, is all the information that you're giving them in that new account form about your investment background. At the end of the day, it is universally agreed that a financial advisor has an obligation to, at minimum, I would argue they have a fiduciary duty to you, but at minimum, they've got an obligation to make recommendations that are suitable. And the new account form is the document that brokerage firms rely on in evaluating whether or not the investments in your portfolio are suitable, and they're suitable based on the information you give them. In that document is going to be information on your work history, your age, your income, your net worth, your investment experience, your investment objectives, your risk tolerance. Those are the basic ones. But there are others, but those are the ones that go into the suitability analysis in terms of what a financial advisor's obligation is to look at those considerations and make a recommendation that's suitable for you. So all of that information is included in your new account form. And again, the significance of that is that is the information that the brokerage firm is going to rely on when, John Smith Financial Advisor recommends XYZ stock, and they're going to quickly glance at your new account form and say, okay, for Nancy Drew here, she says that she's, worth $50 million and she's been investing for 30 years and she's got a huge income and she's, used to work on Wall Street. Okay, we're going to improve this. Clearly she understands what she's getting. And this is suitable for her. The reason that we see a lot of problems with the new account form is in terms of the information I wish you had versus the information that they have is, of course, the financial advisor knows this. When he's having you fill out this document, he knows that his back office compliance, this is the document they're going to look at when they say yay or nay on his recommendations. And this is particularly significant, not necessarily in sort of the stock or bond, type recommendations, but let's say we're talking about alternative investments, private placements, oil and gas partnerships, non-trade REITs, and a ton of our cases over the last few years have involved that type of product. This is the document that your brokerage firm is going to look at when he says, okay, I recommended that this client put $200,000 in this non-traded REIT. And they're going to look at the document and say, okay, here's their income, here's their net worth, here's their investment experience, here's their investment objectives, here's their risk tolerance. Yeah, we think it's okay. Again, the problem, though, is, at least in my experience, a lot of times financial advisors will sort of guide you on how to fill out this document. And I've even seen situations where they'll tell you to inflate the numbers. Otherwise, I can't give you these great investments that I want to give you. And again, at the time when you're filling out this document, this guy's been referred to you. You think he's great. You've had, one meeting with him, but he seems really nice. And so you trust him and you're going to listen to him. And so you fill it out the way he suggests. And again, the problem is years later when the investment blows up and now you're looking to sue your financial advisor, that document can come back to haunt you. Again, at the time when you're filling it out, you thought nothing of it. But I promise you, the financial advisor, again, in my situation, we're always dealing with the bad ones. The bad financial advisor who knows he's about to recommend an improper investment to you, and he knows if he puts down there that you've never bought this type of investment before, you've got a low income, a low net worth, and no real investment experience. If he lets you fill it out that way, his back office is never going to improve it. And so that's why he's guiding you through that document saying, okay, let's fill out this way. And, what's your net worth? And okay, well, what's your house worth? And you say, well, I don't know. We've lived in it for 30 years. And he's like, well, what about 800,000? Could it be worth 800,000? You're like, well, maybe, I don't know. Okay, well, let's put 800,000 on there. And all of a sudden you puff it up to a number that's, north of $1 million. Now he can go sell you this product that he had in mind the whole time. So, that's the significance of that new account form, is that's the document. And when it says information that's not remotely true, that's the defense. In the litigation context, they're going to say to an arbitration panel, look, arbitrators, this is the information they put on our document. We asked them to fill this out and tell us what their net worth is, what their income is. And we relied on this information when we said that this investment was okay, because based on the information they've put here, it is. And if that information is not correct, that's on them. And so, again, that's the significance of that new account form. Make sure that the information you're putting on there, notwithstanding what your financial advisor might tell you, make sure all that information is absolutely accurate, because that is the most critical document. And frankly, you're going to want that to be accurate because that is also your best protection. Those back office people who don't know you, if they read it and say, wait a second, these investment recommendations aren't right, that's your protection. That's what the compliance is there for, is to make sure the financial advisor is following FINRA rules and making recommendations that are appropriate. And if they don't, that's the best way to catch them, is for the compliance person to send it back and say, reject it. We're not going to let you sell this. This is not appropriate for these people. That's the significance of that new account form. That's why it's so important that it be filled out correctly. The second component to it is that it's not always as straightforward as we would like it to be. In terms of the information they give you, in terms of the options they give you, you're probably going to be required to ask some questions, and you're going to want to make sure that you really like the answers. And the examples that I'm referring to would be when we start talking about risk tolerance and investment everyone should have some sense of your income and your work history and your time horizon and your investment experience. Usually the investment experience is like a list, and it says, have you invested in stocks? Yes or no? How many years? Have you invested in bonds? Yes or no? How many years? Most people should remember that. The confusion there, and sometimes the debate we get into when we're representing investors is that, a lot of times they'll say, oh yeah, well, I've invested with stocks for 20 years, but I've always used a financial advisor. They're really the ones who invested. I don't know anything about stocks. And so, that one can be difficult. But brokerage firm will certainly take the position that no, regardless of whether or not you were getting investment advice or doing it on your own, you still have experience investing in stocks. But the ones that can sometimes be confusing are the ones where we're talking about your risk tolerance and your investment objectives, because, oftentimes the language that's used is both a little bit misleading and also sort of meant for it to be appealing to everyone. For example, in terms of an investment objective, one that might be listed is that you're looking for tax advantages. And that might actually refer to a very specific investment where that's one of the components of it. And the one I'm thinking about is there's these oil and gas limited partnerships out there that we've seen a number in our practice. Very high risk investments, but they do have a tax advantage component to it. So a brokerage firm might use that, you say, oh, well, yeah, I'm looking for tax advantage, of course. That representation to justify them putting you into this super high risk oil and gas limited partnership. And the reason I say that can be a little bit misleading is who's going to say, no, I want to pay more taxes. And so when you've got that blank that says, are you looking for tax advantages? Well, of course I am. And so that can be a little bit misleading, is because you're not necessarily thinking, okay, yeah, I'd rather take enormous high risk in this investment than pay Uncle Sam. That's probably not what you meant. All you meant is, well, of course I'm looking to minimize my tax exposure. And so, that's just one example. The other one, you might see is, are you looking for income? Well, who's not looking for income? Obviously, most people, yeah, if you say, hey, you want money? They're going to say yes. But that, again, lends itself to certain types of investments where maybe they're high risk but provide income. But maybe that's not really what you meant. So it's important to sort of look at all those options and really understand what those mean. It's amazing how many times, we get the call and they say, okay, I was conservative. I was looking for some income, but I wasn't willing to lose my money. And on those forms, that's typically going to mean preservation of capital was your risk tolerance and income was your objective. And that is usually a far cry from the investment they got, because they filled it out and said, I'm looking for income. And I'm looking for, moderate risk. I'll accept some risk, but I don't want a ton of risk. And the brokerage firm says, well, then this was relatively appropriate for you. So you got to look at all those options and make sure you really understand them before you fill it out. Make sure they're really representative of what you want. The other thing that we see from time to time, and I frankly think this is ridiculous when brokerage firms even accept these, but sometimes we'll see a new account form where a bunch of them are filled out. You say on there, yeah, I'm looking for income, I'm looking for growth, I'm looking for, high risk. Well, you can't be looking for all those things at the same time. They're mutually exclusive. You can't be looking for preservation of capital and high risk at the same time. But sometimes we'll see new account forms where the client sort of checks them all. Yeah, I want that. I want tax advantages, of course. I want income and I want growth. Well, those all sort of lend themselves to different portfolios. So, again, the big takeaway is that is simply just to pass along that the new account form is the most important document, both for the relationship and certainly if there's fallout and you're involved in litigation. You got to make sure that the information you're putting on there is correct, and make sure you understand any representation that you're making on there. If you're saying that you're okay with tax advantages, make sure you understand what you mean by that. Make sure that it's the same with what the brokerage firm means by that. Because, that is the document they're going to rely on. That's the document that they're going to supervise your financial advisor and use to make sure that basically to protect you, from a supervisory and compliance standpoint, that's the document they're looking at. So it's very important. And we know from our experience that very few advisors or very few investors, understand that because, that's one of the documents that we ask for at the outset to evaluate cases, because we know that it's the most important document. And I can't remember the last time an investor actually had it. It's not a document people keep. They usually keep their statements. Maybe they keep their confirms, but they very, very, very rarely have their new account form. Meanwhile, that's the most important document. So, I think it's important for people to understand that because, if you're about to set up a relationship, make sure you fill it out correctly. If you've already got one, you don't have your new account form, ask them for it. Ask them for it and then read it and make sure that it is consistent with what you actually want. If you read it on there and you know that you're conservative, but the document says moderate growth or speculation, call them and tell them. They are required to update that. A good brokerage firm with good compliance will actually send it to you, every couple of years and just say, hey, is this still accurate? Let us know, because things change. Maybe you switch jobs, maybe your income changed, maybe you're retired, maybe you're about to send some kids off to college and your expenses have gone up. Point is, things change. And so they should be updating that new account information relatively regularly. The other context where they'll send it to you is if there's an investment recommendation that's made and they're not quite sure that's consistent with your goals, they'll send it to you and say, hey, this is what you told us you wanted. Is this information still correct? But point is, again, if you've had a financial advisor for a few years and you don't remember filling out the new account form, call them and ask them for it. They have to send it to you. It's your document. And you'll want to make sure that when your brokerage firm's compliance is reviewing all the stuff that's happening in your portfolio, that they've got the correct information on you. The other thing, and this goes back to filling out the risk tolerance and filling out the new account form correctly, but hopefully your financial advisor is walking you through those and sort of explaining to you what they mean. But it's very important to understand the correlation between risk and return. And I think most people think that intellectually they understand that, but I'm not sure it's necessarily explained adequately by financial advisors. And certainly I think they can sometimes represent an investment as, this offers a great return with no risk. That investment actually doesn't exist. There's a direct correlation between risk and return. So if you're getting an investment right now that pays 8 to 9% in a zero yield environment, I can assure you there's risk. That doesn't mean it won't work, and that doesn't mean that it will go bad. But that does mean that you're taking more risk than an investment that pays you 2%. You just are. That's how it works. Particularly in the bond market, that's how fundraising works. If you're a AAA rated investment like the U.S. Treasuries, you don't have to pay 8% to get people to buy your investments. Right now, you have to pay about 2%. If you're a super large company that has a great balance sheet and has always paid back their debt, let's say at ExxonMobil, you're going to have to pay 3-4% for your corporate bonds. If you're a small speculative oil and gas company drilling in North Dakota right now, to get anyone to buy your debt, you're going to have to pay 12%. And so if you have a financial advisor that's pushing that 12% yield to you and saying it's not risky, it's just a great yield, that is a misrepresentation of that investment. There is a direct correlation. If the company could borrow money for less than 12%, it would. They don't want to pay you 12%. They're paying you 12% because they can't borrow money at 11% or 10% or 9% or any of those other numbers. So there's a direct correlation between risk and return, and we see that far too often. The ones that we saw from the market correction in 2008 were a lot of real estate investments that had paid 7%, no risk. That's not true. The only investment that doesn't have risk is cash in your mattress. But once you make an investment, there is a correlation between the risk and return. If there's a little bit of return, there's not that much risk. But if there's a huge return, then you are accepting more risk, and maybe that's worth it, and maybe it will work out for you. But there is that correlation, and you got to avoid those sales pitches that tell you great return, no risk. That doesn't exist. And going back to just the general, the new account form and the whole purpose of the show, that's going to be on there on that new account form. And when you're filling it out, you gotta remember that and understand that. If they're saying, that they're asking you what your investment objective is, and you want income, but you don't want to lose any money, then you don't want to fill out the one that says growth and income. Growth is the response you would give if you're willing to accept risk in order to grow your portfolio. But if you're looking for income without risk, that is not the correct response for you. You're going to want to look for the one that says preservation of capital, conservative. Income's okay. I mean, you're still going to want income, but you're going to want to do it with less risk, and you're frankly going to get less return. And that's the conversation you should be having with your financial advisor. If your scores all come back as super conservative, and then you tell them, hey, I've got $1 million portfolio, I need $75,000 a year to live on, your financial advisor should be saying, I can't do it, because the only way I can get you 75 grand is to accept risk. And then they should be explaining to you that risk return correlation and asking you whether or not you're okay with it. So be on the lookout for that. And again, just make sure you're paying attention to the new account form and filling it out correctly, because that is the most critical document, both for the relationship and if things go bad. We're going to take a break.
Complete Employee Solutions in Vero Beach wants to ask, what could your business achieve if you weren't taking up precious time with payroll, tax compliance, HR, and the like? If you're a small, growing business, it can be tough keeping up to date with increasing payroll and tax regulations. Without a proactive plan to help you manage your back office burdens, achieving your business goals could get sidelined. Hiring Complete Employee Solutions will allow you to have a paperless payroll and HR tools so you can improve compliance that will attract and retain valued employees. Save time and improve your bottom line. Complete Employee Solutions does paperless payroll and employee leasing too. Complete Employee Solutions. Join the team and feel complete. 567-6333.
Hi, I'm Cindy, the proud owner of Cindy's Cleaning Service. I consider it a privilege to be welcomed into your home or office. We have recently updated our website with new information and offers. Please type in cindyscleaningservice.com. That's CINDIS cleaningservice.com. At Cindy's Cleaning Service, the Lord is my strength.
Welcome back, everyone. You've been listening to Wall Street versus Main Street. I'm your host, Dax White. Before the break, we talked about the new account form and the significance that it has in the brokerage relationship, both in terms of, the relationship between you and your advisor and making sure that he's investing appropriately, but also if you get caught in the situation where you're in litigation, the significance that new account form has then. So, again, the big takeaway is if you don't have a copy of your new account form, call your financial advisor, get it, and just make sure that it's accurate and consistent with what you really want. For information on the show and some of the stuff that we've talked about today, check us out at wallstreetvmainstreet.com. You can also check out the law firm at whitesecuritieslaw.com. And tune in next week, and hopefully we'll pass along some more information that'll be valuable to you to make sure that you've got a productive relationship with your financial advisor. Thanks.
You've been listening to Wall Street versus Main Street. The views expressed by the participants of the program are their own and do not represent the views of, nor are they endorsed by, the White Law Group, its officers, directors, employees, agents, representatives, shareholders, nor any of its subsidiaries. None of the content should be considered legal advice. As always, consult a lawyer.